There's Ed. Hi, Ed.
Dale, hi, how are you?
Hi, buddy. God, it's great to see you, man. And, we let too much time pass between discussions, and you did it again, Ed. Who would know that anyone but you would have a fractal on Janet Yellen? Yeah, I'm just saying, Ed has a fractal on everything.
Exactly. If there's several ways to say it, but if it moves, put a fractal on it. Yeah, and it has been a while. It's actually 100 days, Dale.
Okay.
And the reason I know it's 100 days is because the last time we spoke was at the time of the UK election.
That's right.
And we were talking about, talked about a lot of things, but one of them was about how markets have a habit of repeating themselves in similar conditions, and one of those conditions obviously was UK elections. So what did the market tend to do during UK elections? Forget about deductive reasoning and what all the pundits were saying about what would happen if this and that. What does history show? And we talked about some of the scenarios, and one of the scenarios, the way I presented it to you, or it was presented, was 100 days before and 100 days after the election. So it was almost, when you asked me, can I come on today, I thought he wants another FTSE 100-day fractal because he's run out. But that's it. We've hit.
I believe that, one of the scenarios that you gave did manifest. I'm getting a little echo. Are you in the room? You're not.
Yeah, I'm in the room. Do you want me to break into song or?
No, all you have to do is turn the volume down in the room. So that's we're good now. I don't hear an echo. So that last call on that fractal on the FTSE ended up manifesting. So we had new highs in the FTSE. We had the pound rally after the elections. Is my memory serving me correctly?
Yeah, no, the FTSE, the UK election templates worked well. It's worked well. I mean, it's the story of fractals. A lot of people, increasing number of people are looking at fractals, which is great because it's technology, if you like, that I'm passionate about, but it's also increasingly important, powerful, and followed because of algorithms, not least because there are programs out there that are logically and programmed to repeat themselves and what they see and the conditions. So that's cool. And what is interesting is a lot of the people who are following fractals are doing it by sight recognition. It looks similar, so they put it on it. I mean, obviously you got some like most famously DeMark, who tries to put that 1929 fractal on anything that moves, and he nailed China on the back of it. Good. He missed a couple of other markets on the back of it, but there are great. If someone of that.
Well, what they say, that imitation is the highest form of flattery, and since I've been on Twitter, you were one of the first that I started following that showed the significance of fractal work, and I have noticed more and more people talking about fractals.
Yeah, that's good, but I guess the point I'm really making here, and it is great, but what a lot of people miss, and one of the abuses of fractals is, let's try and find something that fits my view. Let's try and bend it, because price action can, and it does depend on the eye slightly as to how you want to move it or place it. So you put two charts next to each other, and two charts are, they've got two axes and some squiggles. It depends on how accurate your eyes are. That you could say it's similar, it's going up, it's going down, it's going to do what I want it to do. I mean, that is a real problem with fractals, if you like. It's a confirmation bias and abuse, which is why it also gets fractals get a bit of a bad name, because people are out there. And there are a lot of fractals that I see and that are being produced, I'm sure, are wrong, have no real foundation. But let's step back. One of the reasons why I follow fractals for the equivalent of fractals, analogs, and the analogies, whatever you want to call them, for 20 years plus, is simple. And it's a simple approach to markets that the best and the worst and the majority, certainly professional traders and institutions, follow. They use reasoning. They use deductive reasoning about data that they get, the information that they get, and say, well, what happened? If gold does this in this type of environment, then what should the dollar do? Or if US interest rates move in this condition, what would you expect? We do that reasoning all the time. You'll see it through the next 24, 48 hours as the FOMC debates about the possibilities of inflation and growth and the labour market against China and some of the risks out there, and so basically they'll come out with a judgment, saying, well, we'll leave it alone for now, systemic risk, because they'll find some sort of justification to justify their policy stance. But we all use that deductive reasoning. So let's step back. I mean, there's too much of a disconnect, I think, between technicals and fundamentals. The majority of people I know, and certainly the majority of hedge fund managers and people who made serious money over the years, use a combination. They use a combination. It's all very well following the fundamentals and having a narrative that you believe in, that says the dollar goes higher, the stock market goes higher, goes lower, whatever you want to do, interest rates go higher. But you need the evidence on which to trade and to make money and to protect your capital, in other words, to manage your risk. And that's the problem. And that's the beauty of fractals, because it combines. You could argue one or two other approaches like Elliott wave combine the two, but it gives you a map, and it gives you a map through deductive reasoning. So let's step back, let's put aside the bullshit. What is he actually talking about? I'm saying here, in the case of the UK election, is that we know the market has a habit of doing certain things around election time because there is risk, there's a possibility of a certain type of government coming in or not. This is therefore a certain set of policies that could result, that will affect the economy, and therefore could or may not, perhaps more importantly, may not affect the companies that comprise the FTSE, and let's go from there. And so you come out with a scenario, you go back through history and say, what does it do? Someone the other day described me, he said, well, he calls himself a fractalist or uses fractals, but essentially what he is a modern day historian. And that actually hits it on the nail, hits the nail on the head.
Who's Tom DeMond?
Sorry?
Who's the modern day historian?
No, someone called me a modern day historian.
I see. Okay.
That's basically what I'm doing, is trying to match. Now, when I match something in terms of fractals in the shorter term, I'm increasingly driven to price action as opposed to any fundamental or logical reasoning, because there's less opportunity, there's more scope for, say, algos or sentiment or whatever's moving the market to move it. Whereas obviously the more medium to long term you go out, then you look at longer term fractals, and you're necessarily going to be closer to the fundamentals. It's my belief, and I think 99.9% of market participants believe, that in the long term the fundamentals will out. The problem is everything in between tends to be technical noise or algos. But let's go back to, let me just show you what's happened in that FTSE.
Okay, so the screen share is on the upper left-hand corner of the Google Hangout. It's a green arrow that says screen share. See it on the upper left-hand corner if you move your cursor there. There you go.
Okay.
Beautiful.
Right. Can you see when we spoke was there? That's under the N or the NS of conservative majority. Yeah.
Got you.
And the purple is what's happened. What was really quite stunning is the average conservative majority. We produce videos on FTSE and most of the major stock indices, but one of the things about the FTSE we followed is a very unusual analogy, was both political and price action with 1992. 1992, we got a surprise conservative majority when everyone was looking for a hung parliament. Well, believe it or not, 2015, what do we get? We get a small minority conservative government when everyone was expecting a hung parliament.
There was a surprise.
Yeah, and it's kind of a very strange, and then you got the price action following it. Well, what a surprise. But what was really surprising, and it kind of freaked me out a little bit, was the fact it called the dump. It actually projected the dump. Can you see this sideways?
Yes.
I guess you want to call it China. You saw the China crash based on the UK election template. Well, what's that got to do with China? Not a lot, but who cares? So basically now we're 100 days, And the interesting thing about this, Dale, is I'm sure you know this one. There's certainly an old UK folklore that has been that's been changed somewhat in different places. But sell in May and buy St. Leger's Day. Do you know that one?
Oh yes.
Sell in
Yeah.
May and go away. You know, it's been
Right.
very. It's
Right.
almost like Cinderella story. It comes out in different versions wherever you go. But basically in the UK, it's sell in May and buy St. Leger's Day. And the reason, actually, as an anecdotal aside, is because every city gent used to go and play. When it started in May, you got all the seasons. You got the cricket. You got the horse racing, tennis, everything else. So it's summertime.
Yeah. Who cares about the market? Why not live?
What a
Go
sensible
live and smell the roses.
Yeah, exactly. What a very sensible approach. So that's essentially what happened. So let's square up. Let's square our longs, and when we're going to buy it back. Well, when we get back into the swing of things. Well, when does that? Well, it's at the end of the season on St. Leger's Day. And when was St. Leger's Day? It was Saturday. Yeah, and lo and behold, look what's happened. Well, what happened St. Leger's Day in average conservative majorities? Well, there you go. So we should be buying on Saturday. Well, we can't quite do that, but Friday or Monday. There's quite a big difference in price between Friday and Monday, but there you go. But anyway, that's hopefully given people a flavour who don't know me, given a flavour of some of the things to look at and why. And that's cool because that's worked really well. And you want to find out what happens next and what it says, and whether you should buy St. Leger's Day. Then obviously there are videos available for our sales market.
Yes, Ed's a great follow on Twitter at Ed Matz. Follow him.
But anyway, putting that aside, right? So today, what are we going to talk about? We got going into FOMC. I did say that I wanted to cover one of the big trades. Big trades for me of the year was the Nikkei yen, based on this baby. I mean, how sweet has this.
Yeah, that was a star last year, Eddie. Nice call.
Can you see this chart?
Right now, you have the same chart on here. It's the same chart.
Okay.
So you'll probably have to maybe stop sharing the screen and then go to your other screen and share it. Unless you have it all on one desktop.
Got that one?
There we go. We got the Nikkei and the yen up there. From 1989, 1990, yen 2013.
Yep.
Got it.
And let me show you something else, basically. Well, I want to talk about FOMC more than this, and I thought this is quite involved. This is quite exciting. There's a lot going on here that meets the eye, and a lot of indicators or milestones that I'm going to lose people, I think, a bit if I start going on doing this on the webinar. And I really want to.
So the Nikkei blew off last year in a similar fashion with U.S. dollar yen that it did at the all-time peak in 1989, 1990.
Yeah, it followed it. Basically, it followed it, and it's also following the
downside.
The Nikkei and dollar, since then, I mean, we're talking 26 years ago, the market's got an increasingly small place, the world's got an increasingly small place, and so correlations are higher, and the correlation between the Nikkei and dollar yen, and therefore you could argue the S&P, but we'll keep it at dollar yen, and Nikkei is much closer. And they do track each other pretty well, and there's an important time difference. That when I sent out the broadcast earlier this year, I specified what that time difference is, and it's still in play. Rather than start talking about that and running out of time about FOMC, what I was going to suggest is if people, I will send out a new broadcast, a new update on that to those people who I emailed previously. If you want to get on the email about what is still, well, I mean, you can see from this chart, yeah, I mean, if that pans out, then there's something serious out there.
We've gone through some type of paradigm shift, haven't we?
Well, on that chart we did, certainly. Yes, I mean, but that at different times. I mean, people say, oh, well, the criticism always leveled against fractals is, well, this time it's different. The conditions aren't the same, and that is, to a technician who's following a chart, that is like.
So I have a question from the community on that chart. What are the values on that chart? Basically, where was the yen? The Nikkei was what, 29,000? Wasn't that the high?
About 40%. The scale of this chart is about 50%. So,
Okay.
So that's a serious dump. That's the difference between. I was going to say that's not the difference between going on holiday this year and going on holiday next year. It's the difference between owning your house or not. That's the. It's a significant. It's a black swan event. Even if you weren't trading this, if this happened, then it's more than a black swan. It's a group of black swans have come to to sing Christmas carols to you one night. It is quite a serious move. But if you want to find out more, then email that edmatsfractal@gmail.com, and then we can go from.
Take that email down.
Yeah, get that email down. Let me just. So how long have you been on Google Hangout?
We've been doing this about 3 weeks, 2-3 weeks now. Potential of it being more viral than Ustream.
Oh yeah. No, let me just.
Is this more difficult for you than Skype?
No, it's just different. Yeah, I mean, I actually used to do. You remember Sphera? We used to use.
No, that's right.
We used Google Hangout once or twice.
Yeah.
Once or twice. Right. Let's talk about. Yeah, the only problem is I kind of want to share my entire screen. Can I do that? Yeah, of course I can.
Yeah.
Well, let me do that. It's because that's the problem. I'm trying to pick individual charts and flip in and out.
World got bearish commodities at exactly the wrong time, huh, Eddie?
Sorry?
The world got bearish commodities at exactly the wrong time.
Well,
few weeks, yeah.
That's the paradigm. The trade of the year has obviously been oil. But it's a great market. The market that I've followed that is following the oil chart.
Yes.
And it's following the oil chart before the oil chart dumped, I must add. So I'm keeping my eyes close to that one. And funnily enough, it's not too. Can you see this Nikkei dollar yen chart?
Yes. 2011 to current, and yen 2012 to current.
Yeah. Okay. So you can see my basically you can see what it's done. It's followed it pretty accurately. What was I talking about? Yes, and the oil fractal chart, if you like, the template, the oil template is yen related. It's Japan, Asia related.
Yeah, because they have to import all their energy needs.
Oh, okay, yeah. I mean, that's a good question because I would say there's too much of a paradigm shift there for it really to be oil related, and there's also a significant time difference. You're talking probably 12 months that it wouldn't be. I mean, basically what it's saying is this is a similar setup in the price action, and they may have its own drivers, different drivers.
Still with us?
They're still with us. Okay, let's go. Let's forget. So basically, I'm going to send an email out as an update on the Nikkei yen trade, which is had it off basically in the last 6 months. Big move, and obviously part of that move was China. Right. And China is clearly, or like it or not, whether you trade it or not, China is a very, very important influence. It's actually. I think there's a good case to say that the Fed may well be raising rates in this meeting had it not been for China. And, the jury's out a little bit on the data we're seeing. There's been a bit of softening in the US data coming out, question mark perhaps about employment, etc., but this baby, China, is obviously the reason why it's so kind of a bit of a no-brainer. They're not really going to do anything until it's settled itself. Until it's resolved and they feel more comfortable, because there's no point putting up rates to find that the world collapses because Chinese systemic risk, contagion, etc. to find that you've now got a lower rates. Although you could argue they're really clever, they would raise rates and be in a position to lower them should something happen, but they're not going to play.
I think that's the whole reason why they want to do it. I mean, I even heard Yellen talk about potential shocks at one of her news conferences several months ago when people were asking why. She said in case there were any exogenous shocks. So perhaps they saw your fractal on the China A share market.
Well, yeah, there's always a fractal of a shock somewhere. That's the great thing about markets, Dale, is you call yourself a stop hunter. Maybe you should be a shock hunter going out. I mean, just there's going to be a crash in some market, some place in the world every week. If you cover every AIM share, every little penny share out there or whatever, then there's thousands of opportunities to find a template that says there's going to be a crash of some sort. And in fact, if you're of the bearish persuasion, as I've noticed, perhaps strangely, I find the retail market is naturally more bearish in terms of confirmation bias, a natural bias to sell, than certainly my professional, banking, investment banking experience. And I think that's partly that's a timing issue. There's a real habit.
It could be that they have some type of scar from what happened in 2000, 2007. They were long.
Absolutely.
And this time, they're not going to get caught long. They're going to capitalize on a crash.
Yeah, maybe a post-traumatic distress. There's all sorts of disorder, and there's all sorts of reasons why. But let's put it in a more positive way. If you make money selling, then you're more likely to sell, aren't you? I mean, you
Yes.
do whatever makes money, because that's what the name of the game. Unless you're some sort of, some people put out reasons that some people do it to lose money. I don't quite understand that, but I get my head around that. But if you make money and you make money by selling, or you make money by buying, you're more likely to do that. And retail market necessarily, because of the turnover, the churn, whatever, is younger than the professional market. I actually don't know that's true, but it has to be true. What was it? I don't know, actually. It's an interesting question in itself, but I would think the retail market, because there's a high churn rate, is going to be younger in terms of experience, and therefore is more akin to whatever's happened more recently, and therefore be more inclined to sell because of, you're right, 2008, 2009. And as a consequence, in 3 or 4 years' time, maybe more inclined to buy, because we've had a bull market since, and so more people have their, obviously one's experience is more weighted to the more recent.
It's interesting that I see this FOD completing in mid-October. There are a lot of cycle guys that have been pointing towards that time frame for lows in a lot of global bourses. And
bit of a consensus.
You're not a cycle guy, you're a fractal guy, and your methods are pointing towards a similar outcome using different methods. That kind of gives me even more conviction about what can happen.
Yeah, it does seem to be a bit of a consensus, and you got to ask yourself why, because it's, I didn't buy the bottom, therefore I want to buy the bottom, therefore I'm not buying higher up, and therefore it must be going lower so I can buy. No, that's the kind of what's driving the consensus. That's very patronizing me to say that, but it's how sentiment works, yeah?
Yeah.
Individual sentiment is more akin to what the person is doing and what they've done, rather than necessarily what's going on in the market. In other words, what drives markets more the traders themselves and their own psyche and what they're set up than
sometimes you're right. It's what kind of environment you learned in. Also, for me, I was on the floor when they first started trading gold, and it became legal for U.S. citizens to own gold again, and it opened at 200, and within a year or so it's trading at 100. So you're kind of, unless you can learn to shift your paradigm, the environment that you learn in, you tend to go that way. I started to believe down was faster until I was short in blow-offs. But I think that's an important ingredient. I could see it in myself.
Yeah,
being learned in bear markets.
That's a good point, because it's not, that tends to the longer term. If you like longer term history, I'm talking about 3 to 5 years. Longer term individual personal history will flavor your bias. What flavors people's bias in the shorter term is price action. And that's one of the biggest things out there is people's perception of volatility. Personally, I find, and I'm convinced, of all the variables out there, direction's not so hard. Direction's not so hard compared to volatility. Gauging volatility is the art. In other words, you can think the market's going down. It's just like August the 24th, yeah? Market's going down, it's on a short term. Wow, what the heck was that? And then I think it's going back up. That's overdone. Classic limit down. I'm talking about the limit down day. Classic goes back up and whack back up. And you just, you can't always gauge the volatility in some of these things. And that's the problem for a trader, technician, if you like. Because it means sometimes they won't respect levels. In fact, intentionally, you look for markets that won't respect levels because you'll take the positions out and they'll leave the market in a position to carry on. But it means that placing stops becomes quite hard. And therefore, sometimes you have to look beyond the obvious. Anyway, what is driving this market? Quite clear in a number of things. Systemic risk, or the fear of systemic risk, represented more by China than anything else. And then, obviously, with the FOMC, I explained brief. There are grounds to believe that it will raise rates soon. People now looking probably more out to December, and probably they'll be looking today or the next 24 hours for indication that she's deferring things to 2016. And she's got, it's kind of, I keep saying no-brainer, but it's fairly obvious, isn't it? There are grounds for encouragement, however, with systemic risk and China, etc. out there, we're not ready to a position to jump and raise rates because that will be foolish in this environment once it's resolved. And when it's resolved will be when we will look to raise rates, and so when is it resolved? Well, when this chart says it's resolved. And where's this chart? Try 3750. China gets above 3750, that green line. Some people know how I refer to a green capitulation line, that often when it gets back above that line, depending on the market and the conditions, then that's an indication.
So the Fed will feel more comfortable with the Nikkei regaining that ground to move.
China, Asia, yeah. Somewhere in Asia anyway, isn't it? Yeah. And they're not that dissimilar, perhaps.
That's a huge move you have coming up in China. Almost looks like it's going to be an outperformance of almost every market out there on this kind of.
It's more. Look, it goes down and goes up. I mean, you're talking. The volatility in this market is big. I mean,
the highest beta exchange out there, right?
Yeah. Yes. Has been in the last 2 years. Those people follow me will know that I caught the rally. It's been a great market. It's highly volatile. It's out of my hours and probably out of yours as well. I wouldn't trade it. I just punt it. You could call it investing, but it's a punt, isn't it? So look, if it bounces back up to 35.50, something like that, spikes, people gets them out. Again, talking about the volatility in the stops, takes out people selling on the upside, and then you've got a move of 30%. Hello. I only want to buy this market if you think it's going up. Well, what about the 30% on the downside? What's that going to do to the other global indices? And therefore makes you wonder what is going to happen. But look, my point is that China's in the way of the FOMC, and therefore, once China gets above 37.50, then technically it becomes safer. And given that, I personally think this is a correction. It doesn't mean it needs to go back up immediately to new highs within the next year. I mean, if you look at the Nikkei as an example, that's nowhere near its highs. And that typically when you get a bubble burst like this, I've talked about this probably with you actually, Dale, but elsewhere as well at length, when you get a bubble burst, Bitcoin, tulips, whatever you want to call it, oil, gold, it tends to go sideways. Yeah, it doesn't necessarily have to collapse again or go flying to the moon again. It goes sideways.
It's kind of like being in a car wreck after something like that. The market's in shock, trying to find its footing. Yeah, I know.
Well, you're quite right, and therefore loses its impetus. And therefore, not only that, but once it gets some impetus, people will bail on it because they remember too well. It's interesting. We're coming back to a recurring theme about memories and experience driving individual actions and therefore driving sentiment. So, it goes back to why does history repeat itself? Well, hello. people remember these things, and therefore, there's a causal link in not just between fundamentals and price action and therefore fractals, but causal link between sentiment. And algos encapsulate that. So anyway, that's an interesting chart. It's an important chart. I would like to suggest. What else is important? Let me show you. Let me break you out. Let me show you this. This is more in line with. Anyone recognize this chart? It's a 10-year chart, a bit more than 10 years.
10-year yields. Okay.
Yeah, exactly. 10-year yields. Actually, the 10-year note chart I love. I mean, if there was ever curious. I mean, if there was ever a fractal algo-driven market, it looks, but it's not over that time frame. Well, it might be really longer-term algos driving it, but it just repeats itself over and over and over and over again. And yes, every analytician, every technician, everyone with a brain, you think, keeps thinking it gets down to this ABC situation, and then it's a buy and then whack. ABC situation is a buy and then whack. And so let me show you. If I show you this chart, it's the same setup again. Yeah, here we are. Now, if you're looking at that chart, you kind of, as an analytician, it looks like a impulsive back down, three-wave buy against the lows, and then it's the next thing you know, it did that, it collapsed. So let's have a look. If you look at this, because I bought yields, I sold bonds, and I got stopped out when I went to new lows and then back in, and I'm looking at it, looking for the indication that this thing's going to rally. And there's something that's freaking me out. And sometimes with these things, they're like you put them on back burners, you put them in a drawer and say, I don't want this to happen. This is not how I'm trading. This is not how I'm thinking. But if it happens, then I know where I am. Forewarned is forearmed. Being prepared. Shit hits the fan. That's not that bad language. Then I've got something I can rely on. Let me show you this.
So this is looking like a major bond top to you, Eddie, finally?
No, that's my point. Yeah, I mean, yes.
Yeah.
My money says yes. Hello. Fundamentally, everything's in line, and yet, look at the red box. Now, we are. Can you see this? This is the 30. Basically, it's saying this box, what we've done in the last 6 years is a repeat of 2003 to 8. The price action in the bond market, US bond market, expressed in this term by 30-year yields, is very similar to the price action before the
financial crisis.
Subprime. Yes, subprime fallout.
Yeah.
Yeah, right. Okay. I don't believe that. Well, I'm sure a lot of people didn't believe that at the time. Yet, funnily enough, you could argue that the stock markets are probably closer. If you wanted a narrative that stock markets are overvalued, then you may want to attach that. But hey Ed, I thought you were bullish to stock markets. I am, because a simple reason, more than one simple reason, is that technically, fractally, there are reasons why the stock market is not. We haven't seen the right conditions for a major top. Also, fundamentally, the biggest match to the stock markets, talking about DeMark, is 1920s, particularly the low or deflationary growth we saw in the late 20s. Obviously, didn't have quantitative easing, but we had similar setup back in the late 20s. That the economy started turning down. There were signs of cracks in the system.
But it took another year, huh, Eddie?
Yeah,
is this 1928?
Yeah, I think we talked about it last time actually. Yeah. But I want to make this point because it is an important one. Because what happened is the reasons why the Fed did not act. In retrospect, we're always clever, aren't we? Always after the event. It didn't act, and therefore there were reasons why it didn't act in time, didn't raise taxes, didn't perhaps arguably put up interest rates sooner. And the net result was you got they allowed the frenzy, and then the frenzy went into the crash. Or you could be talking about a similar situation where the Fed is not acting because of China, And then this is how I'm just kind of what's the word
Well, wasn't it 1934, Eddie, where the Fed tightened prematurely and took us back down for another economic wave to the downside, and equities too, until World War II because of a premature tightening?
Yeah, that was the point about Ray Dalio came out and said that, didn't he? About you accused the Fed of, if you're raising rates a few months back, that you would be talking about 1934. That's funny how fractals and analogies seem to be increasingly common, but who, so well, we haven't had the 1929 crash. The conditions are quite different. But the point I wanted to make, I'm really going off on one today. What's that? I can't even. This is an interesting argument. Is that because of China, the U.S. The Fed is not raising rates, and as a result, they'll get behind the U.S. curve. In other words, the economy will start to grow faster. You'll start to get signs of inflation, and things will become too tight. And as a result, they'll be behind. In other words, they should be raising rates already, or starting to on lower rates with true quantitative easing. They need to get the system back to what it should be normally. And as a consequence, they'll be chasing. And as a result, things get out of hand as they did in 1929. That's the fundamental analogy. Is that China, ironically, China is stopping the Fed doing what it should be doing, and that's raising rates. And therefore, because as a result, because of the worry over China and the inflation, the risk of a downturn, they actually create the bubble. And it's because the bubble, one could argue that if you had an orderly market that goes up and get corrections like this, that's healthy. That's a Schiller argument, isn't it? You need healthy corrections. Now, when you don't get healthy corrections, then you run the risk of the Mandelbrot blowout to the upside and then the crash. And that's the problem with China. Ironically, China could be ahead of the game because of itself. If the China stops the Fed raising rates, things get out of hand. If the market were to go to new highs now, then watch out. There's going to be a party for 6 to 9 months, and then you're setting the conditions. So just that's kind of like an off the wall. I'm not saying that would happen. I just find the logic and the irony.
I was kind of thinking that, Eddie, that maybe into mid-October, S&Ps take out the flash crash low of 1830. And then we could trade 2,500 in the S&Ps. Is it crazy?
No,
I'll be Bill O'Reilly.
I don't.
Am I wrong? Show me where I'm wrong.
I don't think you're wrong, but I think it's far more complicated than that. I mean, China sharpshooters.
You're talking to Forrest Gump.
No, I'm not talking Forrest Gump. Dale, then everyone's a Forrest Gump, because what you just told me is the consensus view, yeah?
Okay.
The consensus is, now things, people don't understand that, the majority can be right, because the majority change their mind when it reaches there. So the market could be right, could go down into new lows in October, and everyone said, well, everyone thinks it's going up, and therefore they're wrong. I'm not going to buy, and lo and behold, it proves to be right, and everyone wonders why they didn't buy, and lo and behold, it was absolutely as everyone said, but no one traded it. That's the nature of sentiment, nature of markets, and that catches people out. The consensus quite clearly is for an October low. Why? Because people want to buy it because they didn't buy the low. Why not now? Well, because they didn't buy the low, and therefore they wanted to go to new lows, and therefore they may be buying it. We need to get people, like the last 24, 48 hours, this ramp. You need to get people out of their shorts before it can go down. Anyway, that's beside the point. Yeah, I do run a service on S&Ps. Anyone who follows me knows that I keep.
Oh, you're doing that now. Okay.
Yeah. Big time. Yeah, and it's really interesting because let me show you something. Actually, I can't. One of the things the S&P does is, like all these markets, certainly the S&P does, but when there's a strong causal link with an event, a calendar event, you tend to see the same patterns because people recognize the same nature of risk and they square up, or the same issues, and therefore they. Can you see that, the yellow fractal?
Yeah. Yes.
Yeah, okay. That's a kind of like a pretty expression of what the S&P does. That's times 4, but it's what it does into the FOMC and out the other side, and it's been remarkably accurate. And what's interesting is it's shifting as well. It's hard enough sometimes when I follow some of these fractals or follow markets, but when they start shifting in time, it's getting ahead of itself, and I just wonder why it started to move forward. It's like the market's almost moving forward on everything. You know, it used to be a sell. The market always used to top on Mondays, Dale. Yeah? And certainly the first quarter, the first Monday in the month, you know, the first Monday in the year was the time to sell because that's when markets topped. Well, now...
I was always taught, however a market closes Friday, follow through into turnaround Tuesday. Did you ever notice that?
Well, there you go. Your turnaround was Tuesday, then everyone knew that, and then it became Monday.
Okay.
Yeah. It's probably, no disrespect, but it's probably, you know, you've skipped, you haven't followed it so closely, and then it became Monday. So, you know, happily sell on Monday. So what happens now? It's a real pig now, because what it means now is people recognize it's going to happen on Monday, so the market tops on the Friday. So if you want to sell the top, which is, you know, nature of the beast, you have to take weekend risk.
Okay.
The great thing is that volatility, curiously, often is lower on the Friday than on the Monday. But anyways, beside the point. Depending on expiries, etc., etc. What was I going to show you?
Will you answer a bonus? Will you answer a bonus question from the community? Because you're also well known for your views on cable. It's one of your specialties.
Well, I was going to talk about Eurodollar. In fact, the entire purpose of us talking today was so I could talk about the FOMC and Eurodollar.
Right. Okay. Yeah. And so go ahead.
Right. That's the euro. You know, that is Eurodollar fractal. That is the Eurodollar Yellen fractal.
Okay. Where are we on it?
Well,
That's a
$1,000 question. We're in the pink.
Yeah. I'm a thousandaire.
And there's a pink. We're in the pink. Yeah.
We're in the pink. Okay.
We've done the green, and we're now in the pink. So let me show you something. What do you want to know? Let's have a look at that, or not, as the case may be. Okay. That is basically the average of the Eurodollar since Janet Yellen came in 2014. Just showing you this is the way I would look at it. Let's go back. The reason for doing this is there's a reason why markets move. People, there's risk, and people square up the risk, and then there are fundamentals driving a market, and then they have positions and act on the result, the release, depending on what the release is. Often it'll be flavored more by what the existing prevailing positions were, or their inclinations were, than in fact the actual release. In other words, too often, and this is an important point. Anyway, show me the last time, in fact it's on this chart, the last time it paid to have a position into FOMC that you couldn't have got a better price, buy or sell after FOMC.
Looks like 2015.
Well, 2015 there's the average.
Oh, okay.
You know, I'm talking about the minutes.
Oh, I see. 24 hours after 48, 72.
Yeah, so this is 72 hours before and after. So each line represents 24 hours. So you can't answer the question based on this chart. Sorry, this is.
I see.
So
there's no advantage.
No, that's my point. I mean, I know there's people will know that.
The only advantage is that it satisfies a gambler's urge and need and FOMO and everything.
I was just about to say, Paul Tudor Jones said, and this is a lie. Sorry, Paul, but he said he didn't take positions into economic releases because I think what he meant to say was he doesn't take positions on the back or going into on a punt on the economic release because that is gambling and not trading. Okay. And that is the point. And my point I'm making is that you have a view of what the Fed may or may not do. You have a view on your chart or whatever. You can often, it pays from a risk management, capital preservation point of view. It often, where history shows, certainly in this cycle, that it's paid not to have the position. Doesn't mean you should. I always have position into them, but that's the nature of the beast. Let's say that's the same chart. I wanted to show you a couple of things. What this really says for euro dollar, because the price action, this is what is interesting. All right, I think this is the most instructive chart. It's the same chart, but it's just euro dollar average since Janet Yellen came in. One of the reasons for doing this is if the S&P has followed a similar pattern going into FOMC, then it makes sense that the US bond market and euro dollar or dollar, whatever surrogates you want to pick, will do the same thing. And it's quite clear that the market has been a clear pattern. Okay, that's really interesting. So where is it now? Well, let me show you where it is now, because it's not as you would imagine. We talked about how you saying about the Tuesday turnaround Tuesday, where it was turnaround Monday. Now it's Friday. You got to sell it because that's the market's always. I guess the explanation is the market's always discounting. Is discounting itself. Well, let's do this. This is the current euro-dollar chart on the euro-dollar average since Janet Yellen came in. Similar?
Mm-hmm.
The blue chart is the current for the last 3-4 days, and that's the average. You can see that it's saying basically that it's bottoming and it's going back up. Well, the interesting thing about this, Dale, is that we haven't. This is where, according to the average, we should be. In other words, euro-dollar should be trading around 113.20.30 at the moment, ready to break down, but it's already broken down. The S&P fractal is already 48 hours. It's shifted. The market is shifting in its anticipation of FOMC. I don't know why. But okay, that's kind of interesting. So it's saying it's going back up, and according to this fractal, well, it's beyond that, so it goes and retests the high. What does that mean? Where does it go from there, Ed? Well, this is when it gets really kind of interesting, because it's actually very similar also to another price chart I'm looking at. Is that you see, basically saying this is mapping euro-dollar with another fractal. The euro-dollar has it's been a feature of the last year. It's been an aggressive downtrend, and whenever it stops going down, it goes sideways, and that's when the robots, the algos, take over, and what I've called, comically, stupidly, the mangle. In other words, it's a consolidation correction, where the market keeps repeating itself over in different ways, repeating the same mangles. It's done it so many times. This is another mangle. It's following previous price action. Now, the interesting thing about this is it's saying it's a breakdown, and then coming into FMC, you can see how it starts to get violent. Yeah, it ends up going up, retesting the highs, similar to that the Yellen fractal, and then coming down to retest the lows before it goes up, and then spikes, takes out the stops. What the euro-dollar loves to do. It wants to know where the stops are, and it'll take them, and then it'll do what it wants to do, fundamentally, which is an important point about what's.
Aren't all the stuff in the euro Ed under the Draghi low from the ECB press conference? Anyone who's long has their stop under the Draghi press conference.
What's the euro-dollar done for the last 3 months? I'll tell you what the euro-dollar.
Sideways.
Yeah, exactly. So there are going to be stops both sides of the market. This is basically our euro-dollar view. This my colleague Don Haynes put this out on a video. We do videos, MarketVision TV.com. This is a video from, in fact, 10 days ago, just to show you that. Look,
great work. Nice.
Yeah, it's great. It's going to hold the 10.15 low just above it. Then pull back up to, oh look, just below 114, and then it's going to come up.
What a coincidence.
Yeah, funny that. I wouldn't.
That you had that nailed before the fact.
It would have confused everyone. But
is that the first time? First time you've called the market before the fact?
Yeah, no, probably. Well, no, look, Dale. If it was the first time, then it doesn't matter. Then everyone needs to take the service, because if I am 99.9% wrong, then that is more valuable than anyone who's ever 80% right.
You're right. Yeah, we could fade everything you say if you were wrong.
Gosh, if you ever find anyone who's that bad, they are. You just want them. They are. They're gold dust.
I'd like to introduce myself.
No, that's not true. You see, this is the problem. 50-50 doesn't cut it. You know.
All right. Okay. So I'm 50-50. All right.
No, I don't know. I'm not. I wouldn't. I don't know for a start.
Well, I don't either. I don't either. But you know what? You never failed to disappoint us, Eddie. I mean, I'm seeing that the big call is Janet does nothing because of China. She's going to wait for China to stabilize, and your big picture on
all right,
the dollar.
let me sum it up.
Yeah, go ahead, do that.
Okay, there's quite clearly, I mean, forgetting the charts. Well, in fact, the charts support the euro. Let's go back to that euro dollar. Bear in mind that that says where we could potentially have topped. I actually think from a timing point of view, it's wrong. The euro dollar does things far more slowly these days. Because when it moves in trend, you know it because it really moves. But it means that as a consequence, the corrections seem to be much longer in duration. So yes, according to that chart I just showed you from the 6th of September, 10 days ago, yeah, it's got to our levels. It should now collapse. Yeah, great. And yet this fractal says that it could mangle a lot more, and that retests the high. And what it's saying is on Janet, it does nothing. Yeah.
Yeah.
The market is not going to say anything. That it's just she's just going to throw out red herrings. I was going to say, but kites. Well, once China's resolved, well, we know 37.50 China. Then certainly technically it's resolved. As to whether she'll believe it's resolved or not, I suspect she will.
That's a great view, Eddie, because the expectation is they do nothing, that the dollar's going to get hammered. And at the most, maybe it's just a pop in the euro on non-action.
Well, I mean, we've seen it in a number of markets. We've seen it in DAX. It feels like last week. It was last week. It was September the 9th, which is a week ago today. The DAX spiked to new highs, took out the stops, and then went. There's a risk. I've shown it on China that I think China's going to come down, retest the hose. Maybe that's Chinese for high. Hi-ho, silver. But it's going to take out the recent highs before it goes down to a new low, which is the orthodox S&P view. Well, it's my orthodox S&P view, but the new low, yeah, and then China can rally. Same with euro dollar, yeah. Right, 1370. Let's say it goes back up. Let's say this fractal's right. It's right so far, and it holds the low, then goes down to the low, and then you know if 1370 is a mega level. What do you do at 1370? Oh no, I'm wrong. You're out of the trade. Now it can go lower because it spiked 1370. Yeah, maybe.
Right. Yeah.
Maybe. You tell me. I don't know. Maybe 110.85. We know 110.15 was a big level, not 110.85. Fell short. So maybe it spikes 110.85 and people are hitting 110.30 bids, and next thing you know, it rips back up. As I mentioned earlier, volatility is one of the hardest things to gauge, even with fractals, even when it's showing you in front of you. You can twist. This tail can be sometimes a bit higher and lower. But it's basically saying that, watch out. If it doesn't break down and sustain the break, then it's likely to take out the stops before it moves lower. And that's basically, you want to wrap that up. What it comes down to is that the FOMC is on hold. It's not rocket science. It's that the systemic risk from China, the contagion, is unlikely to jump ahead and do what they should do, which is raise rates. And that there is a risk. There's a risk in doing it. Within that process. Well, the dollar will end up. Maybe she'll say something that they're minded to raise rates, and that's what puts it back down a low, and then say we're not going to raise rates for a while, and then it ramps, takes out the stops on the high, and then it goes lower. And maybe the irony here, Dale, is that is for much of the last year, the market has been debating as to whether U.S. economy is stronger and therefore they can stop quantitative easing. But if they stop quantitative easing, then the stock market won't go up. The bond market, we'll see to that. And therefore the market trapped itself. And then China comes on and you get the spike down. Well, maybe, if China spikes down, then you'll find you'll get spikes both directions, and I think that's what it's saying is there is a story here. The dollar will get stronger. There is a story here that China will recover, the S&P will recover, but we need to stop people out. There's too whippy, too volatile. There's too many people invested. we need to take them out before it does what it needs to do. So if you're a long-term buyer of the stock market, China, wherever, then you wait till you'll get better levels as the world and his wife becomes bearish again. Then there'll be a better opportunity to buy. The same with selling dollars, I would argue, and based on this fractal, is that once it's broken, it comes down, it may have a chance to break down, but if it fails, then you'll see the stops go on the upside. How do you trade that? Don't trade. Increasingly, I don't know whether it's because of the options market, but the obvious levels count for little. I was going to say nothing, because that's not true, but count for very, very little. And the obvious levels, if one tends to think are historical levels. So 113.70 was the high up at my stop above it. And the next thing you know, well, actually there's a trend line at 113.99. Well, that's also the 50% retracement. So maybe that's the level. And then everyone starts talking about 140 in the figure. Well, then that's the obvious level. When I was going to say, when I started trading, and probably when you were well into trading, there used to be a certain type of trader, and there still are, but they used to be far more common, who just want to know where the levels were, technical levels, so you could just buy through the stops, take people out, then the market could do what it should do. And
I noticed that when I was a runner on the floor. You get the big roar once they took out the stops, and it was normally a reason people were long into the buy stops, covered their longs, and it was usually a temporary, at least, and sometimes significant highs, vice versa, on sell stops. So therefore,
I'm a great believer in knowing a market well, and that's when partly the fractals. Understand the market you trade. Look at the history. What does it like to do? And if it respects levels, then so be it. Respect levels. If it has a habit, a Eurodollar is a classic one of taking out obvious levels and stops, then look, wait for it to take out the stops. It's kind of one of the hardest things to do, but wait for 108.65 to go on the euro and buy 108.15 was what we did. And well, that's a break. You should be selling it. No, that's not what the Eurodollar does. And the same thing. Understand how the market trades and then trade accordingly. Don't bring your textbook into a market that can't read the textbook, because that's not the way it happens. That's
a pearl. Don't bring your textbook into trading hours. The market can't read.
Well, I would really emphasize that point. Read the textbooks, understand the textbooks, and then not forget everything. But actually, that's a good point. Then just put it aside and then go and trade. Yeah, and you'll remember the trade. You'll recognize the head and shoulders, and you'll say to yourself, "Well, these are the right conditions for a head and shoulders. This is the wrong place for a head and shoulders. This market doesn't like head and shoulders. This market loves head and shoulders." Look, the difference between the S&P loves head and shoulders and DAX hates head and shoulders.
Interesting.
Yeah, they're two stock markets. So
know the personality of the instrument you're trading.
Exactly, and then trade according. How does that mean? How do you then impact a fundamental event like FOMC onto that? Well, as a consequence, then the Eurodollar will take stops. That let's say both the DAX and the S&P were setting up head and shoulders. One would work and one wouldn't. It's just probably the DAX would go to new highs, stop it out, and then and the S&P wouldn't. It's the type of the approach. But I would, one thing also, if you're going to get to know your market, but also be prepared to let it go. In other words, unless you have to trade, then don't trade. Pick your level. You're waiting for, let's say, you believe this fractal, you believe Ed, or MarketVisionTV.com. You think it's really bearish. Let's say you got some. The best way of trading this would be to have some puts because vol's collapsed, and your puts, and you're going to stay short through there, and then you'll wait for but you're not short in the cash market. And you'll wait for the stops. You'll wait for it later to go down to the lows, hold, rally, take out the 113.70 stops. Here we are, 114 bid, 114.70 yours. And then you sell the cash. And if it goes down without you, well, you've got the puts. That's always easy to say that, you've got the puts, but let it go. Tomorrow's another day.
Exactly.
There are 1,001 markets out there. If you get to know your market well, it means you can't necessarily either an anorak or addicted to markets like me, so you know quite a lot of markets reasonably well, or you have a range of markets you know well, and then you go and pick on another one. So you miss the euro dollar, so on. You know. And as for cable, the question on cable, yeah. Look, Dale, cable's interesting. Cable looks really bullish. I mean, very, very bullish, and it's done it 3 times in the last 4 months, 6 months. It's looked really, really bullish, and net result is it's come back down. Okay. But the great thing about a market that looks bullish is, and if you think it's bottomish and it looks bullish, well, buy it, yeah. And then you run it up, and then you think, well, this is where I start to disbelieve, and I'm not so bullish as the price action may, could be construed to be. Therefore, get out. And if you're brave or stupid or whatever, like me sometimes, you sell into it. You feed it, and then it seems like you're mad, and then 48 hours, well, lo and behold, you're right. Like 154.70 on cable. It looked like it was going to explode, but always said that you need to go to 153.30. And now, same token, there's another fractal, different period of time that says cable is going to do exactly the same thing as this euro dollar chart. Well, that's a surprising story, given that euro sterling is going sideways, and given that the euro dollar has got this scenario. It actually says cable will do the same thing. June the 4th, cable.
Thank you, Mark.
But there you go, Dale. I finished.
Yeah, thank you, Eddie, for that analog on the pound and euro together, and thank you for increasing our understanding going into this event tomorrow. And I hope that pips rain down on you for the rest of 2015 and going forward. So, again, another amazing interview, buddy.
Oh, you're welcome, Dale. I'm trying to get back to what did you say came down on me?
Huh?
You said something rained down on me.
Pips. I let the pips rain down on you, so that it would be like a flood of pips chasing, rolling into your account.
Sweet. Thanks, Dale. Yeah, and it's always a pleasure. And maybe we'll talk about something else in 100 days' time. Yeah.
Okay. See you in 100 days, my friend. Good hunting, Eddie.
Oh, and if anyone wants to, the Nikkei yen, Edmat's fractal at gmail.com.
Edmat's fractal at Gmail, and @Edmat's on Twitter. And Edmat's, I consider you a friend and a great tactician. You're one of the hardest working traders I know. Thank you for your time today.
Well, hard work brings luck, yeah, and we need it.
Yeah, okay. The harder we work, the luckier we get, right, Eddie? Exactly.
Well, Dale, stay lucky and don't work so hard.
Okay, buddy. Thank you, Eddie.
Okay.
Edmat's, everybody. How about a thank you for Ed and the time that he gave us today, over an hour. This is recorded, so you're going to be able to play this over. This was an information-packed interview. I hope everyone enjoyed it. Did everyone enjoy the interview? So he did give us, I asked him a few times, Ricardo, about the pound. So he's saying the pound is in a similar fractal to Euro USD. So obviously looking for some shorting opportunities there. And with that, we've run over an hour. So we've run over 20 minutes. Oh, sorry. I forgot. And I'll wrap it with before the Fed. If you need a car, come to LAR. If you want to be a star, come to LAR. If you are confused and don't know where things are going, just come into LAR and the charts will all be showing. So if you really need a car, you might want to check out LAR. See you guys tomorrow. Enjoy the rest of your day. And remember, don't just count your pips, count your blessings. Money comes and goes. Time is gone forever. Thanks for sharing your time with us today, and make it count. See everyone tomorrow. Good hunting. You're welcome, Rob. Thank you. Thank you, everyone, for your your looks. Here's Rob Kane's Euro. You're welcome. You're welcome, Ali. You're welcome, everyone. See everyone tomorrow. Ciao, baby. Adios.